Have you ever dreamed of becoming wealthy, imagining yourself living in a grand mansion, sailing on a private yacht, or simply holding a stack of money and feeling the freedom it brings? Of achieving financial freedom and living life on your own terms? Picture yourself relaxing on a pristine beach, traveling first class to exotic destinations, and enjoying a lifestyle where you call the shots. It's a dream shared by many, but the path to wealth isn't always clear. The journey can seem like navigating a complex cityscape with winding roads, standing at a financial crossroad, or getting lost in the hustle and bustle of a busy financial district. In the world of finance, two names stand out as beacons of success: Warren Buffett and myself, Robert Kiyosaki. Our stories and strategies have inspired countless individuals to pursue their own financial dreams. We both achieved financial success, but our approaches are as different as night and day. Imagine two distinct paths in a forest, one leading to the bustling world of Wall Street, and the other to the tangible assets of real estate. Warren, known as the Oracle of Omaha, is a master of value investing, patiently buying undervalued companies and holding them for the long term. His strategy involves meticulous research, understanding market trends, and having the patience to wait for the right opportunities. I, on the other hand, advocate for building streams of passive income through real estate, businesses, and intellectual property. My approach focuses on creating multiple income sources that work for you, even when you're not actively involved. This essay will explore our contrasting philosophies, examining our investment strategies, views on risk and debt, and approaches to wealth building. We'll compare financial graphs and charts and take a close look at different financial documents to understand the nuances of our methods. We'll delve into our educational philosophies, highlighting the importance of financial literacy and a proactive mindset. Financial education is the cornerstone of both our approaches, empowering individuals to make informed decisions and take control of their financial futures. By the end, you'll have a clearer understanding of these two distinct paths to wealth and be better equipped to choose the one that resonates with you. Whether you lean towards the stock market or real estate, the key is to take action and start your journey towards financial independence today. My journey to financial freedom began with a simple lesson from my rich dad, my best friend's father, who taught me the power of passive income. He stressed the importance of acquiring assets that put money in your pocket, rather than liabilities that drain your resources. Real estate became my cornerstone. I learned to spot undervalued properties, negotiate deals, and generate cash flow through rental income. Each property added to my passive income stream, bringing me closer to financial independence. But I didn't stop there. I ventured into businesses, building companies that generated profits without my constant involvement. I explored the world of intellectual property, creating assets like books and seminars that continued to generate income long after the initial effort. Warren Buffett's approach to wealth is rooted in the principles of value investing, a strategy championed by his mentor Benjamin Graham. Buffett meticulously analyzes companies, searching for undervalued assets with strong fundamentals and long-term growth potential. He's a patient investor, often holding on to companies for years, even decades, allowing compounding to work its magic. His investment philosophy is characterized by thorough research, a long-term perspective, and a focus on intrinsic value over market fluctuations. Buffett's success with Berkshire Hathaway, a conglomerate holding a diverse portfolio of businesses, is a testament to his value investing prowess. His ability to identify undervalued companies and hold them for the long haul has earned him the reputation of being one of the greatest investors of all time. Section 4. Taking risks versus minimizing mistakes. When it comes to risk, our approaches diverge significantly. Risk is an inherent part of any financial decision, and how we handle it can define our success or failure. I believe in calculated risks, leveraging debt strategically to acquire income-generating assets. This means carefully analyzing potential investments, understanding the market, and making informed decisions that can lead to substantial rewards. To me, the biggest risk is not taking any risks at all, remaining trapped in the rat race of working for someone else's dream. By not taking risks, we limit our potential for growth and success. Warren, on the other hand, is risk-averse, preferring to invest in companies with a wide margin of safety. His approach is to find solid, reliable investments that offer steady returns without exposing himself to unnecessary risk. He emphasizes minimizing mistakes and avoiding permanent capital loss. This means conducting thorough research, understanding the fundamentals of the companies he invests in, and being patient. His investment philosophy is built on the premise that it's better to miss out on a good deal than to make a bad one. This cautious approach has served him well, allowing him to build a substantial fortune over time. This difference in risk tolerance stems from our contrasting views on debt. Debt can be a powerful tool when used correctly, but it can also be a dangerous liability if not managed properly. I see debt as a tool to be used wisely, while Warren prefers to avoid it altogether. By leveraging debt, I can amplify my returns and achieve my financial goals more quickly. This difference is reflected in our investment strategies, with me embracing leverage and Warren favoring a more conservative approach. While my strategy involves taking on more risk for potentially higher rewards, Warren's strategy focuses on preserving capital and achieving steady, long-term growth. Ultimately, both approaches have their merits. Taking risks can lead to significant rewards, but it also requires careful planning and a willingness to accept potential losses. Minimizing mistakes, on the other hand, can provide stability and peace of mind, but it may also limit opportunities for growth. The key is to find a balance that aligns with your personal financial goals and risk tolerance. Whether you choose to take risks or minimize mistakes, understanding your approach and staying true to your strategy is essential for long-term success. Educating yourself, staying informed, and continuously evaluating your investments are crucial steps in navigating the complex world of finance. By doing so, you can make informed decisions that align with your financial objectives and help you achieve your dreams. In the end, whether you take risks or minimize mistakes, the goal is to build a secure and prosperous financial future. By understanding and embracing your unique approach, you can navigate the financial landscape with confidence and achieve lasting success. Section 5, the Cash Flow Quadrant. In my book Rich Dad, Poor Dad, I introduced the Cash Flow Quadrant, a model that categorizes individuals based on their source of income: employees, self-employed, business owners, and investors. This model is a powerful tool for understanding how different people earn their money and how they can shift their mindset and strategies to achieve greater financial success. Employees and self-employed trade their time for money, often working long hours and relying on a steady paycheck. They are on the left side of the quadrant, where income is directly tied to the amount of time and effort they put in. On the other hand, business owners and investors have their money work for them. They are on the right side of the quadrant, where income is generated through systems and investments that continue to produce revenue even when they are not actively working. I advocate for transitioning from the left side of the quadrant, employees and self-employed, to the right side, business owners and investors. This transition is not just about changing jobs, it's about changing your mindset and developing new skills that allow you to build and manage assets. This shift involves building assets that generate passive income, such as rental properties, stocks, bonds, and businesses. Passive income is money that flows in regularly without requiring active work, allowing you to build wealth over time, allowing you to achieve financial freedom and escape the 9-to-5 grind. Financial freedom means having enough income to cover your living expenses without having to work a traditional job, giving you the freedom to spend your time as you choose. My approach emphasizes financial independence through entrepreneurship and investing in assets that generate cash flow. Entrepreneurship involves creating and growing a business that can operate independently of your direct involvement, while investing involves putting your money into assets that appreciate in value or generate income. It's about creating a life where your money works harder than you do, allowing you to enjoy the fruits of your labor without being tied to a job. This can lead to a more fulfilling and balanced life, where you have the time and resources to pursue your passions and interests, providing you with the freedom to pursue your passions. Whether it's spending more time with family, traveling the world, or dedicating yourself to a hobby or cause you care about, financial freedom opens up a world of possibilities. By understanding and applying the principles of the cash flow quadrant, you can take control of your financial future and create the life you desire. Section 6. The Power of Compounding. Warren Buffett's investment philosophy hinges on the power of compounding, often referred to as the eighth wonder of the world. Compounding is the snowball effect of earning returns on your initial investment, as well as on the accumulated interest. He understands that time is an investor's greatest ally. By investing consistently and allowing compounding to work its magic, even small amounts of money can grow exponentially over time. His long-term investment horizon allows him to ride out market fluctuations and reap the rewards of patient investing. Buffett's approach requires discipline and a long-term perspective. It's about delaying gratification, reinvesting earnings, and allowing your wealth to grow exponentially over time. His strategy demonstrates that slow and steady wins the race when it comes to building wealth through compounding.